Everybody, welcome to Financial Statement Analysis Part 6. My disclaimer and copyright notice. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So our last topic here is we're going to be writing a paper. Okay, so, and what we're going to do is we're going to go ahead and incorporate a lot of different things that we had done previously. But the first thing we're going to go through and do is we're going to set up a Google Doc. And we'll call this a sample paper. Okay. So in terms of going through and doing this, when we do write a paper, we want to make sure that we have a header. So let me just find one. And let's see if we can do another one. We can do it like that. So this is actually not a bad one. Let's go ahead and use this. So this is going to be spring 2022, whatever your accounting course is. Okay, so what we're going to do here is we're going to kind of go through and follow the various different steps that I have laid out here. And again, depending on your class. So the first part is basically, why did I choose So the first part is, why did I choose the company based on the list that was provided to me by my instructor. I chose to look at Meta Platforms. NASDAQ, Facebook, as the company had recently, let's call this Meta, as Meta recently saw a significant decline in its stock price and has recently been in the news due to the whistleblower Frances Haugen. Let me just make sure I spelled her name correctly. Okay, so right over here. So this is Frances Haugen, right over here. So this is, I found her coming out and discussing Facebook was very, very interesting. Okay, so discussing about Facebook's or discussing about Meta's behavior towards users. Okay. So that's my introduction in terms of why did I choose the company. About Meta. Taken from the 10K filed by Meta on so we're going to go over here to Meta Platforms. I'm going to go to the 10K, and that 10K was filed on February 3rd, 2022. And we can find out if you look at this here, the February 3rd, this is going to be indicating the date that their document was filed. Okay, so I've given attribution. What I can also choose to do too, if you want to, in the paper, you don't have to do this. You can also give me the link. Okay, I would probably make this a little bit smaller, but here we go. Okay, so when we look at the 10K, what you're going to find is you're going to see part one, they're going to talk about their business. And so if you look at over here, they're going to give an overview of the company, and they'll talk about the competition and the like. So what we can do at this point is we can go ahead and copy this. We can go ahead and copy this right over here. Now, could I find a better, Meta, God, what is this? God, Meta Platforms. So welcome to Meta. Okay, so who we are, company info. Okay, so our principles, all this other kind of fun stuff, our history. Let's see if we can find an about Meta. Okay, so building the metaverse. Wow, they are going through, they're all in on the wow, okay. So here are all their different technologies. So if I found something here, let's go to investors and let's see over here, company info, see if we can find out. It's taking us back over here. Who we are, welcome to Meta. And I'm just going to go ahead and copy it from the 10K. All right, so enough of that. All right, let's go back over here. So I copied and paste, and let's see what happens. Okay. So when we go through and do this, let's just go ahead and Meta builds technology that helps people connect. Meta's useful and engaging products enable people to connect and share with friends and family through multiple devices, personal computers, virtuality headsets, wearables, and in-home devices. And I can just go ahead over here and I can just make this a little bit easier if I do a find and replace. Okay. So Meta builds technology that helps people connect. Meta also helps people discover and learn what is going on in the world around them. And so right over here, 2D screen, which Meta believes is the next evolution in social technology. Meta reports financial results for two segments, family of apps, and Reality Labs for family of apps to generate all of our revenue from selling advertising placements to marketers. Ads on our platforms enables marketers to reach people based on a variety of factors. And this is where it gets creepy right over here. So our products, our family of apps includes Facebooks for old people like me. Right over here. And we can kind of just put this in here. Products include, it's a place for people. Okay, so Instagram. Okay, let's see me do I'm terrible at some of this stuff, so just appreciate your patience as I try to navigate through this. Okay, so look, by the way, if we're doing this in real life, what we also want to know is how do we go through and there we go. Okay, so I can kind of do the same thing over here. This is why you want to take Professor Carolina Casoy's, her variety of different classes that she offers. Okay, so this is about Meta, which we basically have taken from their SEC filing, right? So again, I would appreciate if you could try to make this as like get rid of the we's. The other thing we want to do too is you're going to share this with me if you're in my class. And the other thing that I'm also going to do as well is I'm going to go ahead and put down here, I want to insert page numbers, and I can just do that over here like that. Okay, so let's go look at the next thing. Okay, so about the company, about the comparable company, let's talk about why we chose Twitter. So let's kind of A, B, C, about Twitter. Okay. The other thing I'm just going to go ahead and do up here is like, let's also just kind of change the font to be consistent. I'll make this 12 point. Okay. So about the comparable company. Now, here's what I want to do because I went through, and this is where I can kind of use the information that I've already done. So companies comparable, and I'll just talk briefly. So Twitter was chosen as Twitter is listed, Twitter Inc. was chosen as Twitter is listed as a competition by Meta. So if we look over here and we see under the business, so if we come back over here and we list on the competition, we can kind of see that Twitter is one of the competitors of Facebook. So what we'll say here is that Twitter was chosen as Twitter is listed as a competitor. By Meta. Additionally, I thought that because people or users can post streams of thought onto Twitter, they have the same capability using some of Meta's platforms, including Instagram and Facebook. Okay, or Facebook, what you called internet for the elderly like me. All right. So that's about the comparable company. What makes it comparable? I could also maybe perhaps state that although Twitter is not directly comparable in size or market capitalization, their activities are somewhat are competing with Facebook, with Meta. Okay. So that's all you really need to say in terms of that front. And again, you please feel free to use, so please feel free to use what you said in the earlier part that I had. We went through and posted about why you went through and chose Meta. Okay. So state the two ratios that were selected and why we selected the ratios. So okay, so the first ratio that was selected was the return on equity ratio. Second ratio selected was the return on assets ratio. Okay. Now, what I want to do here is I want to say why I didn't choose from certain groups. And if you go back and watch the video that I did when we were going through and selecting them, what you'll remember is when it came to the liquidity ratios, liquidity ratios were not selected, as both Facebook and both Meta and Twitter are in relatively strong financial health and have the ability to pay down their current obligations. Okay, we can also say over here, coverage ratios were not selected because Meta has no debt. Although Twitter has debt, the focus on our paper is on Meta, and therefore these coverage ratios were not selected. Let me just make sure I've got, yeah, coverage, leverage ratios were not selected. So again, I'm telling, why did I not go through and choose certain types of ratios? So again, it's because for our situation here, they don't really apply to, these do not really go through and apply to Meta, which is our primary company. Okay, so we've got that so far, and now we're going to go ahead and talk about, well, so basically we chose the return on equity ratio, as both companies enjoy a relatively large amount of shareholders' equity. Relative to total assets. Additionally, and so, and the return on assets ratio was selected to see how, what do we say, the return on assets ratio or total asset turnover ratio. So over here, we're trying to also to see how efficient the companies were in using assets to generate revenue. Now, what I want to do over here is I want to show, let's make sure we're going through and citing when I'm using the various different ones over here. So what I want to do, and this is not the proper way to go through and cite, but that's really not what I'm looking for. And over here, so for the return on equity definition, we're just going to go ahead and put these up here just so we can so we chose return on equity, and what we can say is how efficient the company is in generating profits. So, and how efficient the company is at generating profits. Okay, so what I'm going to do here, so I'm going to go ahead and put this over here where this belongs. I'm going to go ahead and shrink this down. Okay. And we're going to go ahead and here, and we'll also go ahead and shrink this down. Okay. So again, just make sure that those links are there for me to go through and use. So the two ratios that were selected, you do not need to say anything about the price to book or price to earnings. Rather, we're just kind of stating what these ratios were. Okay. The next step is state the two ratios and then give information from the ratios, give your conclusion. So what we need to do at this point is we're going to basically describe really briefly return on equity is calculated by taking net income and dividing by total shareholders equity, by average shareholders equity. Okay, so that's what we can say. So what we want to do is we want to go to the ratios that we went through and used, and we're going to go ahead and bring those in. So we're going to go ahead and go to return on equity. And so the return on equity for Meta Platforms was 31.1%. Maybe just go ahead and copy this over here. And let's see what this looks like when we bring it in. There we go. That works. And maybe make this like this. There we go. Okay. So next thing we want to go through and do, we'll say this is for Meta. And now we're going to have for Twitter. So let's go ahead and pull this information up over here for Twitter. Okay. And I'm going to do something right over here to fix this before I move forward. Okay. So let's go ahead and one other thing that I want to do. for Twitter. Okay, so what we're now going to go through and state is that comparing the two companies, Meta has a greater return on shareholders' equity. Now, this is where we want to kind of incorporate some of the issues with Twitter and also talk as well about is the impact of stock compensation expense. And this is going to get into and it's only applicable for these companies because if we look at the accounting add-ons for Facebook, right over here for Twitter, we were at a loss of 221 and stock compensation expense was 629. And so what I want to do here is I want to say that for Twitter, it appears that, again, this is from my prior analysis when I was going through and looking at these companies. Briefly, going through at first glance, Twitter's return on equity is significantly less than Meta's. However, it must be noted that Twitter had a significant income tax expense during the year ended 12/31/20. Additionally, if stock compensation expense was added back to the net loss of Twitter for the year ended 12/31/21, the return on equity would be significantly impacted. Okay, so here's what you're going to want to do. And this, again, is just applicable to these companies. But this is how I want to go through and explain it. So if I say it's 408,492, and what I can do is I can come over here. What I can now say is recalculating the ratio with this information. The return on equity for Twitter would be 408,492 divided by 67638,641, or approximately 5%. However, this remains significantly lower than Meta. If Meta added back its stock compensation expense for the year ended 12/31/21, we're now going to go ahead and do is we're now going to go ahead and show this over here. Okay. And if we say recalculating the information with the return on equity for Meta would be 48,534 divided by 126,585. Okay. Or 38.3%, which is a pretty decent bump. Is significantly higher than Meta. So using this ratio exclusively, Meta, and what we're going to want to say over here is we can basically say that Meta is more efficiently generating profits over Twitter. Okay, so right over here, this is the return on equity. And so this is how I would go through and prepare my analysis. Let's now go ahead and do the same thing for the next one, which is the total asset turnover. Actually, let's see here. The second ratio was selected was the total asset turnover. Okay. So for this one, what we're now going to do is I'm just going to go ahead and copy this because I want to kind of use the same format for both. And I'll just go ahead and update it. So ratio 2, total asset turnover. Total asset turnover is calculated by taking revenues and dividing by average total assets. Okay. Over here for Meta, so let's now go to our total asset turnover for Meta platforms. Okay. Then we'll go over here to Twitter. Okay. So comparing the two companies, Meta has a greater, Meta is generating revenues more efficiently Okay, let's see what we said over here. We want to use that same language. Basically, Meta. Okay, so comparing the two companies, Meta is generating revenues more efficiently from its total assets at an almost 2 times rate for the year ended 12/31/21. And what this really means is that 0.37 times 2 is going to be equal to 0.74, almost 2 times of Meta's 0.725 return on our total asset turnover for the year ended 12/31/21. Okay, so right over here, so we've kind of gone through and have talked about, so far it looks like Meta is winning on these different sides. So let's go ahead and take a look at the next one. The next thing we're going to go through and talk about are the accounting add-ons. And we want to discuss if these add-ons were material to our company or to the comparable company. So when we talk about the accounting add-ons, what we're going through and doing is we're talking about the stock compensation expense. So let's go over here. Okay, so accounting add-ons as defined by our instructor are as follows. Stock compensation expense. 2, right of use assets. And 3, goodwill and other intangible assets. Although required to be included in our financial statements, these add-ons may materially distort the financial results. Okay, so first talk about stock compensation expense. So for Meta, we're going to do over here is we're going to go to our accounting add-ons for Facebook or for Meta. And what we'll do is one other thing we're going to add here is a percentage of pre-adjusted, let's say to see here. So as a percentage standpoint, this is about 23% of net income. And this is roughly about 18% of net income. Okay, so for Meta, we come over here. And we'll make this a little bit bigger so we can kind of fit it all in. Okay. So so for stock compensation expense is materially significant for Meta. as the amounts represent more than 5% of the of the calculated net income. Just note something over here. It's not necessarily going to be 5%. It could be a smaller amount, but for this purpose here, it's big. So for Twitter, when we look at Twitter, go ahead and do the same thing over here for Twitter. And when we go through over here, this will be more of a percentage of unadjusted net loss, which is always fun to go through and to do. Okay, so for Twitter, so let's go ahead and put this over here. So stock compensation expense for Twitter is more materially significant as if than for Meta, because if the stock compensation expense is added back, Twitter would become profitable for the year ended 12/31/21. So that's the first accounting, going through and doing the first accounting add-on. Okay, so stock compensation expense. This is, and I'll share this with you, and you are free to copy this part of it. Just make sure you say it's my instructor, Sid Tchaikovsky, said it. Stock compensation expense is considered to be an add-on as when the journal entry is made, stock compensation expense is being debited while additional paid-in capital common stock is being credited. Our instructor, and you can also say yourself, but you can just blame it on me. Our instructor believes that the stock compensation expense artificially deflates retained earnings. And you can say whether or not you agree. I blank with our I agree / disagree with my instructor, because you can say why you agree or disagree with me. I have no problem at all if you disagree with me. That's absolutely fine. We are all entitled to have multiple opinions in the metaverse. Ha ha ha. Okay. So right over here, now let's talk about the next one. So our next add-on is going to be operating leases. Okay. So now we're going to get okay. So it was right over here. Okay. In at the beginning of 2019, or as of January 1st, 2019, publicly traded companies recorded, began to record leases, operating leases, as both a asset and liability on the company's financial statements. Our instructor believes that this is an add-on, as if we are leasing office space, the owner of the office space is including the office space as an asset on their balance sheet. And by recording an operating lease as an asset and liability, this process tends to inflate the financial statements of companies in the United States. Okay, so over here, what I would like you to do, tell me why you agree or disagree with this statement. There's not an incorrect answer. I will not be upset with you if you disagree with me. Again, we're all entitled to our own opinions. Okay, so for Meta, Meta's operating leases. Actually, here's what we're going to do with this. We're going to go ahead and we're also going to say goodwill. Actually, let's do this. Okay, so we can simultaneously do this over here. And let's combine this with letter C. Okay. So goodwill and intangible assets. According to Investopedia, when computing the price to book ratio, let's put this over here. When computing the price to book ratio, assets, the market value of the company is divided by net assets. The net assets of the company is defined as total assets less intangible assets, goodwill, and liabilities. Okay, so what we're going to do here is we're now, so for Meta, the impact of operating leases and goodwill and intangible assets was as follows. So if we come over here, and let's go ahead and go to Meta. Let's go to Meta Platforms. Okay. Okay, we can get rid of some rows here. Okay. Yeah, again, Michael Salviani, who also teaches with me at Irvine Valley, I did a presentation and he's all, dude, you got to clean this up. Your work is just like terrible. And I totally agree with him. So here we go. All right, so this is how we're going to go through and show, and now we'll go ahead and do the same thing over here for Facebook. Excuse me, for Twitter. Okay. And with here, we're really not going to be commenting on this directly. We'll kind of do that when we get to the price to book ratio. So that's really what the purpose of this part of it is. So let me just pull this up. Okay. 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 So here we go. So this is basically for Twitter. Okay, so this is what we're going to go ahead and do. So now what we're going to do is we've identified the accounting add-ons. Let's go to our next topic. So, so actually what we should say though, is that are the operating leases material to each of these companies? So what we can say is, are the operating leases material? Well, it's definitely going to be greater than 5%. Because this 1.127. So if I take 1.1 plus 12.7 and I divide this by 165, it's about 8%. So when it comes to are these material, I would tend to say yes. So what we'll say is both the operating leases and combined goodwill and tangible assets are material to Meta as these exceed 5% of total assets. So I'm not going to do this here, but what you would say is like the lease liabilities of approximately 13.1 billion over 166 billion is going to be equal to this percentage. The goodwill plus and intangible assets of approximately 20 billion. I'm just combining the numbers, divided by 166 billion is approximately this percentage. Okay. So for Meta, excuse me, for Twitter, we would probably say our material to Twitter as these amounts. So lease liabilities are approximately 1.3 billion of the 14 billion of total assets. Okay, goodwill and intangible assets are approximately 1.4 billion of 14 billion. And just we would show the percentages here. Okay. So our next one is to show the computation for the price to book ratio and conclude on what the ratio reflects. Okay, so for the price to book ratio, and this is letter F. Okay. So the price to book ratio takes the market value of the stock and divides the result by assets minus by net assets. Net assets are defined as assets minus intangible assets less. I think I just said it, so I'm just going to copy it up here. So I'll just copy this right here. Okay. So let's go ahead and bring this up over here for Meta. Okay, so the price to book. So what I want to do here is let's go ahead and show the whole computation. And that looks kind of bad. Okay, hold on. Let's go ahead. So if you have your paper linked, and I'll be able to look at this on the paper. So we'll just go ahead and we'll just do this part. Okay. So this is for Meta, and then over here for Twitter. Okay. Okay. So based on the price to book ratio, Twitter is priced slightly lower than that of Meta. Okay, so when we look at this, how do we come up with this? How do I know it's priced lower? Well, this is basically trading at 4.62 times book value. This is being traded at 5.3 times book value. So it's priced slightly lower than that of Meta. So pricely slightly lower than that of Meta. Okay, what else can we say about the price to book ratio? Well, is this something that where we're kind of seeing, are these companies overpriced or not? I'm not going to conclude on that here, but again, I think what I would want to do at this point, based Twitter is slightly lower than that of Meta. Some would potentially consider, actually, here we go. That is slightly lower Meta in terms of a price to book ratio. Okay, now we're going to conclude. Thank God this video will never end. Okay. Based on your information above, would you recommend an investor or borrower invest in the company? If you were an investor, would you recommend a holder sell? Okay, so Conclusion. What do we want to call this? Let's call this, I'll call this our conclusion. Okay, so what I want to do is I want to kind of talk about the ratios here. So even though Twitter's price to book value is lower than that of Meta. Okay, even though it's lower than that of Meta, Meta has a stronger return on shareholders' equity and has a better return on total assets than that of Twitter. Therefore, by looking at the ratios alone, this may not be necessarily the best way to evaluate the companies. Okay, now here's where I can talk about things outside of the analysis. And so when you're going through and doing this, just make sure that you're using data that's, like historical data. I'll give you an example. So let's talk Twitter stock price. Okay, so if I do a max, so Twitter is presently trading as of 2022 is trading at approximately $34 per share. Off from its recent historic highs of 77 as of last year. Additionally, when looking at the financial statements of Twitter prior to investing in Twitter, I would want to look at the historical financials more in depth prior to investing. Okay, so Meta. As of 2022 is trading at approximately $206.16 per share, off from its recent high historic high of $378 as of September 10th, 2021. What is challenging for Meta is that Meta appears to be shifting its focus into the metaverse. And okay, furthermore, okay, let's see here. So let's go ahead and talk about the stock price. Okay. So when we're concluding about this, my personal opinion is that Meta has a lot of challenges ahead. So I'm just going to talk about them. So for Meta, has many challenges to face. Okay, one is the Frances Haugen whistleblower effects. Two, Apple and Google reinforcing user privacy platforms, which will make it, which has made Meta's advertising models more difficult to, which has made Meta's advertising models more difficult to enhance or more difficult to maintain. Three, Mark Zuckerberg has come under increasing scrutiny by regulators. By the way, we don't really have to really talk about Twitter. We're talking about Meta. Has come under increasing scrutiny by regulators, as he is the sole, that he is viewed we're going to go ahead and get rid of Twitter stock price because we're just analyzing Meta. Okay. Is a sole arbiter of acceptable content, and Mark Zuckerberg can never be ousted as CEO of Meta, as Mark Zuckerberg controls Meta with special voting shares. So here's where it gets tough. So although I believe that Meta will continue to perform strongly, I believe the factors, the challenges listed above would indicate to an investor that Meta may be risky in the long run. And like my opinion for Meta would be this. My personal observations would be that Meta, that Mark Zuckerberg should potentially step back into more of a senior level role and allow others to bring their inputs into the company. And I think that with Frances Haugen, I think that one more of an advisory role and allow others to bring in their inputs in the company. I think what Frances Haugen really kind of brought in terms of when you have a mindset of one individual coming and talking about, one person really having that kind of influence or dictating over a company, I just don't really think it's really healthy. Now, one of the things I want to say is that this conclusion is because I look at these companies all the time. I am not expecting you to have something like this, but I'm putting this out there because I really want to kind of challenge you to really think about what is it that in terms of, again, when you're looking at these companies, there's no correct or incorrect conclusion. Rather, what I'm really looking for are your thoughts in terms of going through and looking at this. So again, I want to thank you for joining me here today. I'm sure you're kind of saying, Tchaikovsky, you're absolutely nuts, and I am, but I am nuts in a way that I really want you to have the very best possible education. And hopefully you found that this paper is a helpful way of getting to that point. So I want to thank you. And if there are any other videos you would like me to create or take down, please feel free to leave me a comment. Have a great day, and I'll see you in the metaverse. Have a good one.